If you think your bank is ripping you off, you're probably right. An inquiry conducted by the Australian Competition and Consumers Commission, the ACCC, published in March 2018, found that Australia's 5 biggest banks are charging loyal home borrowers significantly higher interest rates than new customers. The report found that ANZ, Commonwealth Bank, Macquarie, NAB and Westpac charge existing borrowers an average of 32 basis points more than new borrowers. Now, a discount of 32 basis points for an average mortgage of $375,000 equates to a saving of $1,200 in interest during the first year. This is just one of the findings from the interim report of the Residential Mortgage Price Inquiry, which is being conducted by the ACCC under instruction from the federal government. So how do you ensure you don't get ripped off and that you pay the absolute minimum for your home loan? Well, step 1 is don't trust your bank to do the right thing by you. If you don't review your home loan regularly, you will most likely end up paying too much. Paying just $25 a week extra adds up to $13,000 over 10 years. So don't just make the mistake of thinking that reviewing your loan isn't worth it. That's how the banks end up with your money. We didn't have a royal commission into financial services because the banks were doing the right thing. You need to negotiate a better deal, and to negotiate effectively, you need bargaining power. If you have someone who places millions of dollars in loans each year with the banks negotiate on your behalf, it will almost always result in a better deal for you. Step 2 is to take control of your repayments. No bank has ever lent money on terms that benefit the borrower. Now this part's relevant if you have a portfolio of loans, say a mortgage, maybe an investment loan, a car loan, a couple of credit cards, and a store card, etc. Paying the absolute minimum for your loan portfolio on a monthly basis is critical to ensuring you have cash left in your pocket at the end of each month. Then you can decide on what you want to do with that cash. You might want to spend that on the kids' education, take the family on a holiday, or pay it off your mortgage. The choice should always be yours, not the bank's. Step 3 is to understand the principles of time cost of money and appreciating assets. What this means in simple terms is that the value of money decreases over time. That is, you get less for your dollar, but the value of property tends to increase over time. For instance, according to the Victorian Government Land Services, the median home price in Listerfield South in 2001 was $208,000. In 2018, it's over $1 million. So if you've borrowed 90% of your purchase price for a home in Listerfield South in 2001, you would have borrowed $197,600. Now imagine for a moment that over the next 17 years, you only paid off 2/3 of the loan. You would now only owe $65,800. But your home, according to CoreLogic, would now be worth just over $1 million. So in 2001, $197,600 buys you a house. Today it's a 20% deposit on a house. Understanding these principles allows you to put your debts and repayments into perspective. Hi, I'm Nick, the founder of Truth Group. I assist property buyers, investors and loan seekers in making smart, hassle-free decisions. Don't tackle this journey alone. If you're ready to achieve your property goals, book a 30-minute property buying and mortgage makeover today.